If there's a problem, he will go to the nth degree to help and try to find a solution for you.
Got everything passed up, ready to go. Went into a medical screening, and I'm 6'2", so I am too tall to fly the F-22 Raptor.
Process of buying down interest rates and like how that works with lenders. And I know that's how lenders make.
Saved up enough money to get myself into a motorcycle that would drive faster than 45 miles an hour.
Right. You already kind of touched on a bunch of things, but for people that are looking to invest in real estate or bolster their credit score, right?
Having a good credit score gives me a better rate on my mortgage. So, or it gives me a better rate on my car payments, or it gives me lower rates on my credit cards.
Welcome back to the Wealth Juice podcast. As always, it's your boys Ryan and Corey here with another episode for you. Today we interviewed Matt Ballentine. He is a real estate investor and mortgage lender out of Scottsdale, Arizona. Corey and I had the pleasure of meeting Matt when we hosted our mastermind group out in Arizona with Jesse Ray, Growth House. It was Immersion Season 3. And as you know, I probably have explained this over and over and over to people, but there was no bad eggs out there. And Matt was one of the people that, it's so funny, man. There was networking, breakout rooms, there was podcasts getting recorded, and Matt was bouncing from every room, just asking how he could help. I saw him give 2 breakdowns on how to build your personal credit and fix your credit. And people were having breakfast, sitting with Matt and just taking notes. And he was just helping people. And he was always there. He showed up every single day. He was the first one there, last one to leave. He even had to leave to go coach his kids a football game. They won the game. He came back. It was Halloween. He had to go out with Halloween and he came back. Like he gets it and he's willing to help. And he's got an incredible story. He touches on it briefly as we kind of go through the episode, but he's overcome some hardship, some mental battles as well. And he's come out on top. I'm just so proud of the guy. And he's called Mr. Fix It, or that's what they called him out there, right? He and Corey kind of gets into this in the episode, but if there's a problem, he will go to the nth degree to help and try to find a solution for you. He's one of those guys, one of those rare guys that is just willing to put ego, business, money aside and just help people for the sake of helping people and make the world go around, which is hard to find these days. And so I say all that to say this episode was really about building business credit, how to build your personal credit, and tactics for kind of have a strong financial foundation for yourself as you get into buying your first property or second property, and how to find the right loan package. He is an expert on finding loans for people that are becoming real estate investors, and to make sure you're not pigeonholed as you get into loan 4, 5, and 6 from the first one. Maybe you took the wrong loan out and you just put yourself in a hole. So he really has a tailored roadmap approach to make sure you're setting yourself up for the long term.
Yeah, I don't even know. Have you covered it all, brother? He works for Barrett Financial Group, and that's the company that he resides. And he's, like you said, he's out in Arizona, but he was just really helpful for us. So I know he would be really helpful for our community, and not just our community, but people that are listening to the podcast too. So without further ado, let's bring in Matt and let him share a story.
Let's do it. Matt, officially welcome to the Wealth Juice podcast. Corey and I are so excited to have you on the show, man. Little prelude to the intro here. We met you out in Scottsdale, Arizona when we were at the Growth House Immersion Season 3 a couple weeks back. And we've riffed back and forth on all the things you've done. You're a real estate investor. You specialize in loan packages and helping people secure the correct loan packages for their current situation when they get into the real estate investing game. And you are a wealth of knowledge out there, great guy to hang with. So we are very excited to welcome you to our community and share your story with our listeners. So thanks for being here.
Hey, thanks, Ryan. I appreciate that, man.
Absolutely. So take us back. Let's talk, I don't know, maybe pre-real estate, if there is a pre-real estate, but tell us a little bit about your story and then your launch into entrepreneurship.
Yeah. So pre-real estate was pretty interesting. I took after high school and like kind of going through that, trying to figure out where I was going to be in life. Ever since I was 8 years old, I wanted to be a fighter pilot, right? Like that was my dream. So I turned 18, went to the ASVAB, did all the things for the military. And I came from a pretty big military background household as well. Got everything passed up, ready to go, went into a medical screening, and I'm 6'2". So I am too tall to fly the F-22 Raptor. This is all back in 2006. And they were like my dreams from being an 8-year-old boy until I was 18 were crushed all in one moment when I found out that I was too tall to fit in the cockpit. So from there, I was like, well, what do I love to do? And I love to talk to people. I love to help people. So I was actually going to school to be a therapist, right? Like that's really what I wanted to go and do. And I ended up, like most people, going to college and working a serving job over at Cracker Barrel here in Arizona. Do you guys have Cracker Barrel?
Yeah, few and far between, but
Yeah.
we have them. Not like they do out there or in the South.
Yeah. So that's what I was doing. And as I was going to school for that, man, of course, living the broke college kid life, I saved up enough money to get myself into a motorcycle that would drive faster than 45 miles an hour. Before that, I was driving a scooter that literally would only go 40 miles an hour. And so needless to say, I got the motorcycle, was on cloud nine about that, doing great in school. And I ended up getting hit by a drunk driver on that motorcycle. So again, like went from, changing career paths because I was like, now I can't wait tables. I'm not able to do what I was able to do before. And I had a friend who was working at JP Morgan Chase. And he was like, dude, you should come work with me in the call center. Sit down. You don't have to run around the whole time. I was like, all right. And so I put in an application for Chase, got hired right away, and started my career in banking right there.
Love it, man.
Yeah.
So, you kind of have a unique situation where you're figuring out what to do. You went into banking. I know real estate kind of plays a big role in your story, and now you're in the lending space. I learned this about you, that they call you, I don't know if they call you Mr. Fix It, but you fix things, right? That's what you do, right? And I learned that about you when we were in Arizona together. Walk us through where you went from banking, how that parlayed into real estate. And then if you want to share your story on like why they do call you that, that'd be awesome.
Yeah. So, with getting into banking, I worked there for a little bit, and of course, from that accident, I had an attorney that was helping out with it. That took a little bit of time to finish. So I was about a year into working with Chase. I was doing payment processing for them when I started, and then I got this massive amount of money in 2011, and it was more money than I ever had to deal with in my life. Right? It was just over 250,000. Okay. Attorney's fees and everything else came out. So I was left with about 120, had my student loan debts, everything else. And my credit wasn't the best at that time. So I started to look at like, what should I use this money for? So of course I was like, let's pay off all of our debts. Let's get all that stuff taken care of. I took care of those debts, family debts, everything else, like the money that I owed my mom, I paid her back too. Right. Did all the right things in life that way. And then I had about $45,000 left over after everything was done. Right, in cash, which was still a massive amount of money, right? That Cracker Barrel job, I think I made $14,000 the last year I worked at Cracker Barrel. And my job at Chase, I was making roughly $36,000 a year. So not a ton of money, right? But it was decent. And I was looking around and I was paying $500 a month in rent. And I was like, dude, if I go buy a house in cash, now mind you, this is 2011. This is like the lowest point in the market for just about everywhere in the United States. I was like, if I buy a house in cash, I can save my money that I'm paying in rent, right? So I went out and I bought a house, paid cash for it. And that's when I sat down and I did that exponential growth calculation all on my own before I knew it was even called that, right? And I was like, if I just keep saving this $500 a month, I can buy another house, maybe not in cash, but I can do it in about 5 years, right? And then I can do it again after that in 2.5 years if I rent this house out and I just add that $500 from that. So I started to see how powerful real estate was, and it just clicked. And I was like, oh my gosh, this is amazing, right? So going through that process, buying that home, talking to lenders, I realized how many people in this industry don't really take the time to teach consumers like how it actually works. It's very much like, nope, here you go, take this. This is what you're going to do. And it felt like I was just being pushed through this process without really much guidance or education throughout the way. And all I wanted to do was make sure I wasn't going to mess up. Right. And so I got myself into lending at that point because I was at Chase, and a job popped up in my email for a mortgage loan officer. They're like, hey, we're looking for loan officers. And I was like, all right, cool.
Yeah.
Apply for the job, got the job. And I've continued to make that kind of like my presence in it, is just taking that time to really educate people into what's happening and make sure that they understand that what they're doing, the decisions that they're making. So that way they don't feel like they're like I was, just kind of left out there being pushed through the process.
Yeah, it's amazing how many problems get solved by people going through them and then realizing, oh, this is such a problem. And now I have to not you have to, but like you being the one to fix the problem that you already saw how it was supposed to be fixed, that makes life a lot easier, right? So you brought that to the marketplace, which I think is amazing. I want you to talk a little bit about the importance of credit. And it may seem basic to people, but like the difference between you having a 650 and a 750 or a 750 and an 820, like this is a game changer for people that are getting into real estate, especially when you're just starting out and you're not using OPM, other people's money. You need to qualify for loans. And like, I'm sure that's just scratching the surface of it. But if you could just give us like the breakdown of what you tell people of why credit is so important, and maybe the background on how credit is actually like, how is it scored for people, for, somebody who's like, they maybe they understand at surface level, but it's like, let's do a little bit of a deeper dive.
Yeah. So credit's one of those things that it's almost like a fantasy for most people. They don't really truly understand it, and it's not their fault, and it's not their parents' fault. Usually we learn about credit through our families and through people who've been through things, right? So it's like, mom and dad say, hey, charge that credit card up and pay it down. I'm sure you guys have heard that before in credit, right?
Yep.
It's a big, misunderstanding out there. And through working with Chase and some of these other banks, I also worked at Bank of America and BMO Harris, did a lot of this stuff in banking. I learned a lot about the history of how this stuff was put together. And the real part about credit is that it's not so much that like people are using credit wrong. It's just that they don't understand how to use it correctly, if that makes more sense, right? Like credit, most of the time people think about it in a way of, and that not everybody, but some people, I used to think about it this way of I use it to buy things that I can't afford, right? So like I'd go buy shoes or clothes or a car or something else. And it wasn't really about, having that as a tool in my toolbox. It was more about getting the stuff that I wanted, right? And so I was using it really incorrectly. When I paid off all my debts and I started to really learn credit and go through that, what I ended up finding out is that, having a good credit score gives me a better rate on my mortgage. So, or it gives me a better rate on my car payments, or it gives me lower rates on my credit cards. And so with that, and with working in this industry for as long as I have, because I've been doing it since 2011 now, I've learned that if you use credit more as a tool to pay the least amount of the money that I'm working for, or the least amount of money that you're working for, to the banks that are lending you that money, then your dollar can be stretched further, right? So just changing that mindset away from like, it's what I want to have, into, this is a tool that I can use to spend less of the money that I'm working for on a daily basis for the things that are going to help me build wealth, like the assets in my life, like my rental properties or the investments that I make. Then at that point, my mindset kind of shifted away from it to where it's like, I don't use credit cards for points. I'm not using them for all this other stuff. And we hear about that a lot of, you can use it for points or use it for other things. But I find that it's much more dangerous for me and for a lot of my clients to use it in a way that it's designed to be used, because those designs are really just a way for those credit card companies to make money off of what I'm making, right? So when I understood that fundamental difference of like, these banks aren't doing me a favor, they're a lot smarter than I am.
Yeah.
And they've been doing this a lot longer than I have. And I changed it over to like, I'm not going to use these things for points or for other stuff. And I'm just going to use it to like buy properties, right? Then I'm able to get those lower interest rates. And I help clients out with this too a lot, where we teach them about credit and how that works. That was part of your question, was like, mindset on that. But the other one was more on rates. So like when I start to look at interest rates on a home loan for a client, if they have, great credit, we're going to say, 740 plus, they're going to be in that prime tier for interest rates, where it's really, really just in a great place for them. As that credit score starts to go down, that interest rate moves up in a way that can be really detrimental to what they want to actually accomplish. So, and we're just going to use some round numbers here without being too specific, but let's say, you're at a 740 and that would give you a rate of like 6.5% on that interest rate. Well, if you had a 700, you might be at 6%, right? And then if you were at,
the other way, you mean 7%?
Or yeah. 740 would be 6. 700 would be like 6.5, right? Okay. Yeah, you're right. Yeah, the other way. And then same thing if it goes down to like a 680 or a 660, that interest rate's going to keep going up, meaning I'm spending more of my money towards the interest rate on that payments. And it just really, takes away from everything that's going on there, right?
Yeah, I'm curious about the process of buying down interest rates and like how that works with lenders. And I know that's how lenders make they make money based on like, if you come in and you're applying for a loan and let's say you do have that 750, you can get that 6% rate. But if you pay a point here, which is like, roughly 1% of the purchase price, I believe is typically what a point is. And correct me if I'm wrong, but then if you pay a point, you can get that down to maybe 5.85 or 5.9. I'm curious about that process and how that works and what you're able to tell us from it. I'm just like, how does that process go?
Yeah. So when it comes to like buying down rate or going after making sure that your credit's better so that way you can purchase that home, it's all like a value cost basis, right? So if I'm looking at, hypothetically, if we're looking at like a 6% interest rate and it costs us 1 point to buy it down to a 5.5, it's how much time is that going to take for me to recoup that 1 point? And when we talk about points, I want to break that down just a little bit. So like 1 point is 1% of your loan, right? So if it's a $500,000 house, 1 point is $5,000. Okay. If we're looking at, spending that $5,000 to get that 0.5% reduction, it's like, well, if that is only going to be $200 a month, simple math would tell me that it's going to take me, well, let me do the simple math real quick. I'm not a math genius. I have to do math on a calculator. So 5,000 divided by $200 a month in savings, that would take you 25 payments to get that money back, right?
Just over 2 years.
Right. That's what I call simple math. You guys have heard of how mortgages are amortized, though, like they're front loaded, right? So really we have to front load in that interest. It would change that calculation being closer to 18 months to get that money back. And if you say, okay, if I spend $5,000 and in 18 months, I'm going to basically get that $5,000 back with principal and interest reduction in payments and paying more principal on my home, does that make sense to me? Then that $5,000, it's really easy to say like, yeah, I'm going to stay in this house for the next 2 years. I'm going to make more money by spending that point. This is something I want to do, as opposed to being like really analytical about it and just trying to figure out, like if that's there and in a way that doesn't really make sense to you. So I always put it in a way of like, how long do you plan on living in the home? Okay, this is how long that's going to take you to get that money back. Is that something you want to do? And then it's a simple A/B answer for people when they're buying points, right? Make sure that when you are going through that, though, you work with somebody who has those things. They have like the ability to break it down for you in a simple way and relate it to what you're doing. Because if they don't, it's like anybody wants a lower payment. But if you're only going to be in the house for a year, or if that was not, 2 years and it was 8 years for you to get that money back, the lower payment wouldn't really make sense over that 8-year period.
Matt,
right?
Can you talk to obviously we know the importance of building credit and like what it means, right? It's kind of that, the number that financial institutions look at to see your credit worthiness, right? Or how risky you are to them and if they should lend to you, right? And so you already kind of touched on a bunch of things, but for people that are looking to invest in real estate or bolster their credit score, right? How can they do that? Can you give some tips and tricks of like what it's comprised of? And then also, what they can be doing on a daily basis to dump that down. And I'm asking you this, it was funny. When we met in person, we were hanging out, you were giving like live seminars to 3 different people at the kitchen table. It's hilarious. They like one by one came to you and we're like, hey man, listen, like, here's my score. What do I do? And I literally watched you go down a checklist in your brain and like gave them an end result, which is really cool. It was I was a fly on the wall for your consultation. And this isn't even your main thing that you do, just an added piece. So hook us up with what it's comprised of and then how people can enhance this over time.
Yeah. So there's some main pieces of your credit, right? So the first and most important piece of your credit for most lenders, and this is a general sense, right, is going to be the length of credit or the percentage of on-time payments, right? Percentage of on-time payments, I think it's 35% of your score on average. So it's going to give you a really big impact. Now, if you came to me to buy a house, I can't really change the fact that you missed a payment 8 months ago, right? But you can go to that bank and you can say, hey, I messed up. I missed that payment. Is there a way you guys can remove that payment from me? Now, side note for all of your people out there, if somebody does that and the bank does remove that late payment, they have to return the late fee. Okay. Big thing people don't really understand is like, that's going to cost that bank money. So you want to make sure that you're really polite to them. You're talking to that person on the phone. If that customer service rep isn't great to deal with, kill them with kindness. And then just, if they're not going to do it, call back and talk to somebody else if you have to, right? Sometimes that can really help out. Like one missed payment can really mess up your credit score. So percentage of on-time payments, most important, about 35%. The next one is the percentage of your credit used. So if you have a $5,000 limit on your credit card and you have $5,000 used, that's 100% of your credit that's being used. That's going to hurt your score, right? It's going to then dump down by percentages that way. So it goes from like 100% to 80. 80 to 50, 50 to 20, or 50 to 40, and then 20, 30, 20, and then 10. Your optimal credit range is going to be from 1% to 10%. Okay. So if you have that $5,000 credit card and you had it at a $5 balance, you're great, right? If you have that $5,000 credit card and you have it at a $0 balance, it actually hurts you. It's just like having a 50% of your credit used. So that's the other thing too. A lot of people are like, I'm going to pay them off in full. I'm at a $0 balance all the time. So that's what we're going to do there. The easiest way for people to kind of grasp this one is what I call the Netflix and chill credit approach, right? So if you're not great at managing your credit cards on your own and you really want to boost your score up, pay them down to 0, put Netflix on it, set it up on auto pay. So it pays 100% of the payment every single month. This way you don't pay the banks any interest at the end of the month. If it goes 31 days, they're going to bill you interest for the last 30. So as long as you pay it at 30 in full, no interest, right? And then from there, you have that as a reoccurring payment and a reoccurring charge. And let's face it, man, I don't know anybody who's ever missed a Netflix payment.
Yeah, totally.
I've just never heard of it. Not in 14 years of lending.
That's great. Go ahead, continue. Yeah.
Yeah, no, go ahead, Corey. What's up?
Well, I'm saying that's great advice. I think that people are, it's just misconceptions out there. It's kind of like it's over these people's heads for the most part, and ours too. Even like I understand what my credit score is, but how do you like really dial down to what it's actually made up of and how it actually works? And for us, like I've never missed a payment, but I do probably have credit cards that hover at a higher rate, right, than that 1 to 10%. I pay them off every month, but sometimes we have a month with our business where our credit card's a little bit higher. And then I'm thinking, oh, why is my credit score not 820 or whatever the highest is? It's like 780, which I'm still proud of. But no, I think it's great to learn all that. I want to shift a little bit into the lending and what you do. And I asked you earlier about like, how you fix things, you fix problems that come up. I want you to explain what that means when people come to you and they're trying to get a loan done. Maybe you could explain some of the products that you've worked with and some of the things you do to help people get from A to Z throughout that loan process when they're
absolutely. Yeah. So we definitely look at things like credit. We look at your income. We kind of go through those items. So that's really your basic framework right there, is going through income and credit on any mortgage. Most important part is your credit. Once we go through that, then it's like, how do we get this person into this home that they want to purchase, right? And there's I guess an individual situation when it comes to their finances is just as unique as they are as a person, right? No two loans are ever going to be the same. No two people are ever going to be the same buying homes, and no two homes are really ever going to be the same. They're all very unique in that process. So using a tailored approach to understand where that person is and really taking into account their goals, their views, and those kind of things is my number one. From there, right, getting into the more complicated stuff when we have to fix things, typically that comes in with like professional athletes, business owners, individuals who just won the lottery or just came up on a huge win or a big buyout. Things like that have been really where I've been able to shine in that part of the industry, because there's usually a way to do that mortgage for them and get them into a situation that works. But those types of loans that are going to be more inventive, what we call non-QM in the industry, they typically come with higher interest rates and higher fees, right? So although I can do those for them, it's not so much getting that loan done as it is making sure that person understands how to get themselves back to like a traditional conforming mortgage after the fact, and like showing them like, okay, hey, you file your taxes this way, here's some deductions that you could be taking in a way that's going to be more beneficial to you in the long run, and putting you into a place where you can then qualify for a traditional mortgage product, right? Getting them out of those higher rate loans, or at least giving them that plan or that mindset of like, how do you make your situation better, is really how I fix a lot of those problems. Because anybody can do hard money, right?
Totally. Yeah. I'm curious about this, and I'm not 100% sure if you do these loans or you've seen them, but I'm very curious about how it works to do a portfolio loan, in terms of like, if let's say Ryan and I had 5 or 6 properties that, were matured and they seasoned, is it as simple as trying to go to a bank or a lender like yourself and saying, hey, I want to consolidate these 5 or 6 loans into a portfolio loan? And if you have insight on how that process works, I bet there's people that are listening that are like, yeah, maybe I've had them for 5 or 6 years or 3 or 4 years, and the interest rates have either gone down since when I bought them, or I have a bunch of equity in them. How do I like consolidate my debt on a few rental properties?
Yeah, so I would call that a blanket loan, right? So we would consult. Basically, what you're talking about is taking 5, 6 properties, putting those all into one mortgage, so that way you don't have the servicing requirements where maybe those bills get switched from one mortgage company to another. You're having to deal with that kind of process. Keeps all your payments in one, and it frees up your personal credit or your business credit to where it doesn't show 5 or 6 mortgages; it just shows one. Am I correct?
Yeah,
Yeah,
exactly.
huge benefits there. So typically blanket loans, when I look at them, we're looking at 10 to 15 loans. 5 and 6 is usually on the lower end of that, but it is possible to do with multiple properties. The big things to note is you're going to get an appraisal on each property, right? So each one's going to go through and become appraised to be put into that loan altogether. And then each one of the titles will also be bound together as well. This is a really cool tool though, if you want to use it to like pull a lot of cash out from 5 or 6 properties and do just one mortgage payment. Again, keeping your own personal finances a little more freedom, or if you want to put them into an LLC or a business and get one of the more attractive interest rates, as opposed to doing like a bank statement loan, a DSCR loan, or a hard money loan. It's very much in the commercial real estate realm, but they are a phenomenal product to get you a much better interest rate, kind of secure all the assets together and put you in a good spot.
Would that help you in a scenario? And I'm asking kind of like selfishly, but would that help you in a scenario? Let's say you did have 10 to 15 properties, and I don't know, maybe they're under your personal name. If you consolidate them into one, does then that show to future banks that you only have one loan, or would they still consider that all? So okay, so then you could say, because I'm trying to beat the myth of like, not really a myth, but the thing is like, once you get somewhere between 4 and 10 mortgages, right? Like you can't really get more mortgages, but if you found out a way to have, a bunch of properties, 10, 15, maybe some were seller finance, somewhere, whatever they were, but you were able to refinance them into one, that's pretty cool that could potentially consolidate into being bankable again.
Right. And the cool thing about it again is you're going to get a better interest rate on that than you would for a traditional investment loan. So like, and again, we're just kind of pushing these numbers out there to kind of build some understanding around it. But if you were going to do a conventional mortgage today at a 6%, right, and an investment property would be a 7.25, the blanket loan would be right in the middle of those two, somewhere in like 6.5, right, to like 6.625. So it's going to give you a better interest rate on that overall portfolio of those mortgages and may become much less costly for you guys to do that refinance. You also only pay one set of lender fees, one set of title fees, right? So you're not paying for each individual refinance on each one. So there's a huge cost savings there too. But like you said, a lot of the banks out there will say things like you can only have 4 mortgages on your personal credit, right? And that's where these are really developed, is they would take them out of personal credit, put them onto a business credit line. You're using a debt service coverage ratio. So they make sure those houses can rent enough to cover the mortgage payment on there. And then you're able to do your refinance from that.
Got it. So that's the purpose of the debt service coverage ratio, DSCR loan. And you were mentioning this, and I know some of these loans are what you do. It's maybe not what you specialize in, but you've done them. I'm thinking for people that are listening, the reason that DSCR loans can be advantageous is because you're not taking from your personal liability on your debt to income ratio. Personally, you're looking at the property as a whole, as they do on commercial properties, and saying, does this property bring in enough income to cover the debt? So you can separate that from your personal credit. Am I saying that right?
100%, right? And the big thing with the DSCR loans, again, that's a non-qualified mortgage product. So when you go through that process to buy an investment property, you're going to be renting that one out. You're going to be hopefully cash flowing a lot on it, doing co-living or pad split, or even if you're just buying it outright, you're putting enough money down to make it rent as a long-term rental scenario. That's a phenomenal tool for you to get in, put that under an LLC and not have it on your personal credit. The downside to it, again, much higher interest rate because it's just one property, right? So that 7.25 on a traditional conventional loan might be 7.5 or 8% on a DSCR. When we do the blanket loan, remember that one's going to be even lower than your traditional investment property rate. So that's where the benefit comes in there. It's all about the rates and where you're paying out on those. So you're putting yourself into a better situation to cash flow long term. And again, just like credit does, it's going to take less of the money that you're earning and giving it to the banks. So more of your money's in your pocket, allowing you to invest more over time. And if you use these tools properly, right, and you understand how they work, or you get people around you and in your circle that can help you use these tools to your advantage, you can create plans that exponentially, decrease the amount of time that it's going to take you to succeed in this industry. So yeah,
Matt,
really, really smart
this
that
is-
you're thinking about it that way, Corey.
This is all really good information, Matt. I want to also talk about business credit, right? So we talked about personal credit, and here's an interesting thing. There's, how do I say this? There's a reason for it and a place for it, as opposed to taking your personal, like a personal line of credit out versus a business line of credit out. I want to talk to the situations where you would take one out over the other. And just to give an example, Corey and I were looking at using a hard money lender for something, and we were going to have to pull our credit at some point. He was at least going to look at it, then there was going to be a hard pull eventually. And so I was going through the process, and I was like, I got an alert from CreditWise that my credit score went down. I was like, this is interesting. And I found out it was because we have like 2 or 3 personal lines of credit out with 0% interest, and we use them for part of our business. Corey and I each respectively had that. I, for what in the back of my mind, thought I was a business line of credit, and I didn't realize it would impact my score. So when I went up that percentage that you mentioned, right, like over 10% usage, I think I hit you up on the side. I'm like, dude, which card should I pay down first? Immediately my score went all the way back up after paying one of them down, because I had the usage just over. It was only a couple bucks over that percentage, but you're so right. Like 2 days later, it dropped all the way back down. I'm like, okay, now he can pull my credit, because I was so shocked about it. I was texting Corey. I'm like, dude, like we got to push this meeting. I think I don't know if someone like not hacked me, but I thought I had something going on, because I never had a late payment. Always have monitored within that wheelhouse, the pie chart you mentioned of like allocation. I was kind of freaked out about it a little bit. So I did some research, and luckily
for people that don't know Ryan, hopefully you all know Ryan, but for people that don't know him, if his credit score is not, what is the highest? 850? Like if it's not perfect, this dude's like, what happened? Like it's so, but I respect it, because you really hold that in high regard. And and he was like, dude, cancel all meetings. I think you thought there was maybe fraud.
I just thought something happened. Yeah. And I don't know if like my social security number got compromised or something. I was like, this impacts not only me, but also Corey too. So I'm like, I got to at least let him know, dude, we got to like halt all building for a second. And so back to my original question is like, okay, give us the differentiators between personal lines of credit, business line of credit, how they impact what. And really, I want to focus mainly on the business line of credit, because we have a lot of entrepreneurs or aspiring entrepreneurs that are eventually going to want to go down this path, and why they should maybe steer away from personal lines.
Yeah. So personal lines of credit and business lines is when you don't have business credit. So young entrepreneur just starting out, right? And you're just kind of getting it all started. As soon as you create your LLC, which I'm sure you guys have seen this too, you're going to get that letter in the mail from American Express or Discover saying, hey, we see your business. We'd love to give you a business credit card. So I always suggest to people that are getting started off that they start off with that business credit card to start putting their business expenses on. That's going to help you start to build your business line of credit, right? The next thing, especially with a lot of people using other people's money, right? If you're doing that through an LLC, you can actually have that information reported voluntarily to the business credit lines, which I don't have them in front of me, but I can get you guys that link so that way you can put it in your podcast for people. And that way, if you're borrowing money from, let's say, your close friends and family, doing a syndication deal, or you're putting together money for a property and they're going to be silent owners in that, and it's on credit, you can actually report that as well, which would also be really, really big to help you guys and your listeners to get a better credit score quicker.
That'd be
right?
great. Thank you. Yeah.
On that business line. Because when you start looking at banks, and the banks are like, well, how long has your business been in business? And they're all looking for 3 years of tax returns, 3 years of receivables. They want to look at pretty much everything that you have in order to do those types of loans. And it all depends on the lending institution that you're going to go through, right? So on that commercial lending side, it's not just as easy as saying like, what's your business credit score? It comes into like, what's your personal scores, what's your business look like, who are your business owners, and keeping that really simplified is one of the more difficult things to do. But you kind of put it all in a nutshell. It's like, get that business credit card as quickly as you can on your business line. Report anything that's actually happening on the back end. So that way, people can see that you have debts, that those have been paid back, and that's going on. And then when you do start to get to the actual loans, like blanket loans, or you're doing DSCR loans, when you're closing those in the LLC, even though you may be personally guaranteeing those notes, make sure that they have your business EIN and they're reporting those to your business credit as well.
Cool, man.
Yeah.
Perfect. Thanks for sharing. I'm curious about your business specifically and your next phase of it, like your future goals with it. So I know you're a lender, like you help people out with loans, but Maybe if I miss something within what you do in your business, just tell people so that, if they're listening, maybe they want to reach out to you. And then also, what are your future goals with it? Like, where do you want to take it? Maybe the next 25, 26, 27, like these next couple of years.
Yeah. So, people can definitely reach out to me. I'm really approachable. I love to help just about anybody out at any part in their journey to go through it. I do live in Arizona, so that helps out quite a lot for anybody who's local here. But we work all across the United States, primarily in the West Coast for, any of your listeners there. And you guys will have my contact information, I think, in the thing there for us, right? So
yeah,
as far as where I want to go with my business, so I've been investing in real estate, did my calculation for that exponential growth when I was, buying my first house, and I maintained that path pretty well. So now, here we are from 2011, 2024. I own 4 rental properties, 5 homes in total, looking to acquire another one here this year, probably next year because it's already kind of late in the year. But it's just a phenomenal time to be out there and getting great deals on homes. So we're doing that. And then there's, through that investment in real estate, I've been able to invest in other companies as well. One of those companies is looking at having an exit go on. I can't really name names or talk about that too much yet, but if that happens, then I will be looking to invest into multifamily, apartment style, investments, commercial, or even trailer parks, just because of the potential cash flow on those is massive. So that's kind of what I'm looking forward to in 2020 to 2026, 2027 to really kind of kick things off.
Love it.
That
That's
front.
awesome, man. Yeah, we always like to ask this question towards the end of the show because I feel like it's helpful for people that are just starting out, and sometimes we miss it, sometimes we don't. But I'm curious about if you could go back in time. You've been through a car accident, you've been through ups and downs, and working at Cracker Barrel, and then building a business and helping people with loans. You've just gotten to a point where everything seems to be flowing from the outside looking in. I'm curious if you can go back to your 18-year-old self and you can give 18-year-old Matt advice about life, business, and the pursuit of happiness, or whatever it may be. What advice would you give him?
I tell him same things that were told to me that I actually listened to, which were buy where you live, right? Make sure you can get to whatever you're going to purchase and whatever investments you're going to be. See it, touch it, feel it. Like that's super important when it comes down to it. Stick to my plan as best I can, right? I'm a big advocate of talking to friends and family members about like where I'm going, what's happening, because not only are they good to bounce ideas off of, but it's huge to get that support when it's like all the boys want to go out and have drinks, and I'm like, hey man, I'm saving up to buy a house. And granted, they've heard that from me for the last 13 years, but like they get it now. It's not a problem. It's not oh, you're a downer. It's like, dude, no, we get it. Like, that's awesome. That's your journey. Right. And they support me in that. And it's really, really cool. It's been able to help me keep those relationships in my life. And then last, it's, just don't be afraid to make mistakes. Like mistakes are going to happen. You're going to learn from them. And that's a big part of growing.
Awesome, man. Yeah. Great advice. we got to know you pretty well, as much as we can in a few days, but you've been really helpful in our business. You were helping a bunch of the rookie people that were out there that were looking to get into the game. And you really do. We've heard through other people that you've met that you really are helping people, not just through the loan process, but like the preparation for the loan. And if something falls through, almost like sort of like a therapist in a way. You said you were going to go to school to be a therapist, but you're helping people through that whole process, which I find, it's awesome. It just speaks to your character. So we appreciate your time, man. Thanks for coming on. I think this was very informative about credit, about, business credit, about the loan process, and just like what people can look out for and how they can implement this into their own lives. So if people want to reach out to you, Matt, and they want to learn more about you, maybe get your expertise on the home buying or the investment property buying process, what's the best way for people to get in touch with you?
So the best way is actually through text, through my personal cell. I can give that to you guys. It's 602-400-3238. I make myself really easy to get a hold of. But just understand for your listeners, like text or emails for me, so I don't reply to them immediately.
Yeah.
I'm in the younger generation. And then I think I'm going to be coming into, if you guys are still open to it, I'd love to teach the class that I have on credit to your people, so that way they can get all of it. Because we touched on like really briefly what it's there, but I think there's so much more that people can dive into, and just understanding how they can make those changes in their own personal credit without having to spend all of their money to do it is a really huge benefit to anybody that you guys have. So if you guys are cool with that, I'd love to come back and do that for you.
Yeah, man. I think that's part of like the podcast. People listening, they get a taste, they understand the high level of it. You can only cover so much in like an hour, but if people are listening and they want to talk to us, Ryan and Corey, more about buying their first or next rental property, our coaching program that's exactly what we do. We teach you all the mistakes that or help you avoid all the mistakes that we made and have some look over your shoulder and help you through that process. And then in part of that, as added value, we bring in people like Matt to walk you through the home buying process and the credit process. So within our community, you're absolutely welcome to come in and share not only your story, but just give people maybe the layer or two deep of those details.
Yeah.
So,
well, I think the best way for them to get a hold of me then would be to go through you guys, right? And talk to you guys about like where they're at in their process, what they need. And then when you guys see that I'm needed, I'm more than happy to come in and help anybody that you guys have in your wheelhouse to kind of go through it, right?
Perfect. Cool. Yeah, Matt, I will say you're the first guy to ever drop their cell phone on a podcast that we've been through. So just be prepared. You probably will have some people texting you. I will say for listeners, if you are going to text Matt, at least tell him where you came from so he's not caught off guard. And he knows that we've been hanging out. And so that is step one. If you guys want a deeper dive too, as Corey mentioned, we it's almost like not really a teaser, but we can only go so deep in these episodes, right? We have 60 minutes to kind of go on it. Matt's going to come in and teach a couple of master classes, one being on credit building and really just to help get your financial picture, house in order to invest in real estate and how to appropriately stack your loans that you take out to make sure you're not pigeonholed when you get to property number 4, 5, 6 potentially. So, all that to say, Matt, it's a pleasure having you on the show, man. We've talked for hours, so it's just interesting doing this one live. But we appreciate you. You have a great story. Proud of where you've come from and all that you're doing, and you're giving a lot of value back to people that truly need it when they are starting their journey. So, thanks for all you do from Corey and Ryan, then also our listeners and anyone that hears this podcast. Wealth of knowledge, man. So, thank you.
Yeah, absolutely. Happy to help out, man. You guys are awesome. I'm super excited about what you're doing over there at Wealth Juice. It's just, it's so cool to see that you guys have that same mentality of like just wanting to help people. And like, yeah, it's cool to be around good people. So I'm happy to be here.
They do exist. It takes, it took us a while it doesn't take a while to find people, but to find the right people, right? And getting in the right rooms. I talked about that probably ad nauseum when we were out in Arizona. I was like, man, I finally feel like I'm in the right rooms. And it's because people were vetted. It was good people. No one had an ego. No one had this way of controlling a room and making you feel lesser than. So you were one of those people. So appreciate you, man. And until next time, we'll catch you later.
Sounds good, guys. Thank you.